Many of you know Adam Taggart, the host of Thoughtful Money. This happens to be one of my favorite interviews. It's a long one, so we spoke for almost 2 hours. I would encourage you, though, to not skip around. I would encourage you to listen to the whole interview, even if you have to break it up, hit save for later and pick it up at a later time, because we talk about a lot of issues. And one thing I want to point out here is Adam says that this lag effect, something that is a result of the higher for longer, as the Fed talks about with interest rates, keeping them higher for longer, the stock market and every other asset market really was planning on or holding on to this year being about 7 rate cuts that were sort of promised or alluded to in 2023, but now we know that that might happen. So as Adam is describing some of these implications of our, higher for longer turning into higher for much longer, and also the deficit spending that the federal government is doing right now almost signifies that they're just propping things up until we get to the election, for instance. But also, a lot of people want to blame it on monetary policy, but it's a combination of them both. I hope you enjoy this interview as much as I did. My guest, Adam Taggart. Adam Taggart, my friend, great to see you again. I'm excited to dive in today. We have so much to talk about.
It's a real pleasure, Todd. Thanks so much for having me back on.
One of the things I like about our time together is you spend so much time doing what I'm doing with you right now, and that's interviewing people. And I know that I had the pleasure probably of having one of your only interviews where you can find on YouTube of somebody interviewing you and getting your opinions on the economy and the financial markets, and it went over so well. People absolutely love you. They love what you do. And I must say, and I'm not just trying to give you a big head right now, but wow. I must say that you are doing amazing on your Thoughtful Money channel. You're growing so fast. I mean, seriously.
Well, thank you, Mutual Appreciation Society here, and right back at you, Todd. Your channel is doing phenomenal. Last time I was on, I think I talked about my mission of, trying to bring to people who are very frustrated by the lack of good quality content they feel like they're getting in the mainstream financial media. And what I'm trying to do is create financially nutritious content, is the way I say it. Yeah, I don't get much of a chance to sit on this side of the camera, and I had so much fun with you the last time we did this. I'm so glad you let me come back on.
100%. Well, what people don't get from headlines and mainstream media is honesty. I mean, that sounds really bad to say that, because I'm sure that they talk about a lot of truths, but the critical issues that we have with what's going on today in the U.S., they don't cover, obviously, because if they did, people wouldn't just go about their daily business thinking the world is great. Right. I was talking with an economist just recently, and I was kind of curious. I said, most of the people that are running our country, they are baby boomers or the silent generation. I mean, they're up there.
Yeah,
right. And
we have a gerontocracy. Yeah.
Yeah. So when you look at it and you say, okay, well, why is it that we aren't changing things up and actually doing things that make sense? And what he had said was, well, you have to think of, since like the 1970s, we could screw up so badly and just print our way into, out of it and not worry about the implications till now. We can just continue to kick the can down the road. Adam, I want to start out. What I love about what you do is you interview great guests. And I know we want to talk about one specific interview here with an ex-Fed, but I want to get your opinion. I mean, you spent 30 years in corporate America, and you were on Wall Street, you were at Yahoo, you had a big role at Yahoo, you walked away from all of that, and but you have a pretty good knowledge of what's going on, from the stock market to the housing market. And but I just want to get your opinion. I mean, are we really unraveling? I mean, so many people, they want to say that you're a doomer. If you talk about the things, these critical issues, nobody wants to face reality. And I think that's part of our culture right now, is that people want to just sweep things under the rug and ignore what's really going on. But are we falling apart?
Simple question, complicated answer. So the trajectory is not good. Let me just be super clear on that. Now, people like things to be really simple. And I want to be really clear, the world's not ending tomorrow. And it's a the global economy is a multifactorial system. So the odds of it just, breaking overnight and us going into some sort of, Stone Age depression, probably not super high, but they're not like zero either, Todd. So, we have to be cautious here. Personally, I think there are lots of reasons to be skeptical of the dominant narrative right now, which is that everything's great, right? We got strong GDP, we got low unemployment, markets are still near all-time highs. We're going to have a no landing, You listen to Jerome Powell speak, you listen to President Biden speak, they're generally selling sunshine and roses, right? I don't think that level of optimism is warranted, and we can go into all sorts of reasons why. But I do want to balance this out with the people, like you said, who will listen to the, what I would say are the critically thinking discussions that we have on our channels. And they simply say, you guys are just trying to pour cold water on, what should be a good time for us. And you guys are just perma bears. No, that's not it. There are a lot of really valid reasons to be concerned. And it doesn't mean, build a bunker and go hide in it. But it does mean, it's a time for prudence. It's a time that if you're going to play offense, particularly in the asset markets, whether that's real estate, whether that's stocks, bonds, whatever, that you want to be prudent about it, and you want to have some hedges in place, or at least a strategy for if the sledding gets rougher from here, that you're not putting yourself at too great a danger of being too vulnerable to a reversal of the current party that we've had going on in the asset markets. So we can dig into all that. If I can just make one note on something you said earlier, which is, I think people come to this channel, yours and mine as well, for, like I said, more financially nutritious content. And I think some of the reasons why they're not getting it in the mainstream media, I mean, one is the mainstream, the traditional media has kind of become sclerotic. I think it's behind the curve in general in terms of kind of what people are looking for and how people like to get information. But there are a lot of things that are just preventing the mainstream channels from really telling people the truth, or what you and I would consider to be, more truthful information. One of which, from the top level, like, you're never going to hear Jerome Powell say, "Hey, folks, I think we're going into recession," because it would become a self-fulfilling prophecy, right? Everybody would all of a sudden curtail their spending, and economic activity would immediately contract, and we'd be in that recession, tomorrow. Right. So to a certain extent, they're not going to tell us the unvarnished truth because they have policy objectives. So one, you just got to get, for good or bad, you just have to understand that that's a constraint that they have. Secondly, a lot of these other media channels, and let's take sort of like the CNBCs of the world, they have advertisers. These are ad-supported industries, and the advertisers that pay their bills are the BlackRocks of the world, who want you to be buying ETFs. So lo and behold, no matter what happens in the world on any given day, magically that turns into a reason why it's a good day to buy stocks, right? Thirdly, their formats, I think, they're just insufficient for delivering the nuance that an informed investor is interested in getting. And so, if you're on a CNBC, I've appeared a couple of times on some of these business shows, and you get like 2 minutes, if you're lucky, to tell your story. So all they want are clippy sound bites, right, where you can't get into any real detail. And honestly, what they're looking for more than substance is entertainment. They're just trying to get either a provocative headline or a catchy little sound bite that's going to entice the person to come back and watch again after the next commercial break. And that's like eating sugar cereal for every meal. right? It tastes good while it's going down, but it's not, it's not healthy, right? It's not giving you what you need. So I really commend you for joining me in this endeavor to kind of break the mold in media, where they're always pushing you to create a short or a little, 30-second clip. And instead you've got the courage to do a 45-minute or hour plus, detailed discussion that really dives into the data and the nuance of the story, so that the audience leaves with a good enough understanding to be able to take action based on it, which is, at the end of the day, all that matters. Information by itself doesn't have any value if you're not putting it to constructive action. So again, I want to congratulate you on what you do.
Yeah, well, thank you, Adam. I mean, it's preparing people. I mean, and I think that's what most people just watch headline news, and it's not. I mean, you would say if you're more left, you'll watch CNN. If you're more right, you'll watch Fox. I mean, both of them. Really, I mean, just like you said, they have agendas. They have these narratives. They're not covering topics that prepare people. And we really, I mean, the United States was founded on transparency. I mean, and now I think for the first time in my lifetime, I can say, of course, I didn't live prior to my lifetime, but I think the general feeling is that we can't trust the information that we're getting. And that's the scariest part. I mean, if you get to a point where you don't trust what you're being told, and what you just said, I get it. I mean, Powell can't come out and say the sky is falling, because we'll instantly put people in panic mode, and it would be, like you said, self-fulfilling prophecy. Just like the bankers that I speak with. I mean, if they came out and said, wow, our bank is in really bad shape, I mean, it wouldn't take but a couple of hours before they would be in the worst shape that they've ever been in, and out of business, like we've seen in the last year or so.
The bank could literally be in flames behind them, and they're going to tell you everything's okay.
Everything is great, right? But you know what? So is corporate America the same way. I had a conversation with a friend of mine, and we were talking about it. We said, look, there has to be a certain amount of distrust of anyone that has a very high position, right? You have to have a level of skepticism, because what CEO of any corporation is going to stand up and tell all of their people that, they may not be around in 3 months from now, we might replace you? You're not going to say that. You're going to tell them the company's great, everything's going, we're working through it. And then all of a sudden you get a pink slip, or like the old days, but you get let go. And so you're like, wait a minute, he just told me everything was great, and now I'm being fired or I'm being laid off. So I get that. There are a lot of implications. I guess the biggest thing for me is that, we have big issues. We have pensions that are probably getting cut. We have Social Security that, everyone has said is going to go, it won't go away, but I think you and I believe that it is on a path to destruction.
Insolvency, yes.
Yeah. So where do you think, what are some of the implications for this higher for longer? We had spoken before, and you said the market built in rate cuts, and we haven't seen them yet. What do you expect to happen over the remainder of 24?
Okay. So you put your finger on it, which is higher for longer, or what I refer to as the lag effect, right? Interestingly, everybody thought coming into 2023, right, that we were going to have a recession, right? It was the most predicted recession, and it never happened, right? And interestingly, the economy ended up growing quite nicely through that year and into Q1 of this current year. And the markets did great, right? And that's all in the context of the most aggressive interest rate hike regime the Federal Reserve and the other world central banks have ever gone on. They'd never raised interest rates so high so quickly, right? And so everybody was sort of holding their breath, waiting for the recession to arrive. And then, of course, it didn't. Now, lots of reasons why it didn't, but I think a really big one has been liquidity. And liquidity is something it's a fuzzy term, because there's all sorts of different ways to measure it, and everybody kind of has their own different ways of doing so. But most of the people that I interview that track liquidity closely, Michael Howell from Capital Wars being a prime example of that, Their numbers show that net liquidity bottomed in October of 2022, and it's basically been rising since. And so this is things like, well, for sure, it's the out of control fiscal spending that's been going on, right? Right now, we're running one of the highest deficits we have in the history of America as measured as a percent of GDP. In fact, the only other periods in time where we've had the deficit this big a percentage of GDP were during the COVID crisis, during the Great Financial Crisis, and during World War II, right? So it's only other times, right? So three incredibly, emergency periods in our country's history, we had to have rates that high. Now we're technically not an emergency, technically everything's great, right? As I listed those things earlier, yet we're still at these emergency levels of deficit spending. On top of that, you had the draining of the TGA, which was the Treasury General account, which was stimulative, and that was during the whole debt ceiling period. And then you've had the draining of the reverse repo program. So these are all things. Also, the BFTP or BFTP. The Bank Term Funding Program that was passed a year ago to rescue the banking system, that's been providing liquidity in the system as well, right? So that's basically been a rising tide that's overpowered a lot of the other challenges to the economy that you and I will probably talk about in just a moment. And so as a result, people have somewhat understandably begun to say, oh, well, I guess maybe the lag effect's not going to arrive this time, right? Maybe it doesn't matter. And that's how we went from the narrative going from hard landing to soft landing to no landing right now, right? So anyways, the lag effect is basically caused by the contractive effect of the Fed policy, right? Of increasing the cost of capital. That's what the Fed has done by rising interest rates. And it is draining some liquidity from the system at the same time. That's just been getting overpowered by everything else I mentioned. But the Fed is doing quantitative tightening right now, right? The market, has taken all that into account. But as you recall, during 2023, it kept expecting the Fed to pivot, and Powell had to keep coming out and saying, "Hey, everybody, nope, I'm going higher for longer." And the market had to keep walking back its expectations for a Fed pivot. Then in December of last year, Powell surprised everybody. At the beginning of December, he said, "You know what? We're not even talking about rate cuts, everybody, so quit asking me for it." 2 weeks later, he said, "Oh yeah, no, we're talking about it. In fact, we're probably going to do several next year," right? Told the market exactly what it wanted to hear. And then the animal spirits just ran wild, right? And then the markets just went bananas. They went up, the S&P went up 1,000 points, basically went up about 25% from early November of last year until the end of Q1 this year, right? So now all of a sudden, markets back at all-time highs. Housing prices are still at all-time highs too, and we'll talk about that in just a second. But anyways, where I'm going with all this is, okay, so now inflation has really started to thwart the Fed's optimism here, right? It's proving a lot more sticky. And over the past, month and a half, you've had more and more Fed speakers come out and say, well, you know what, we're still thinking about doing rate cuts this year, but we're really getting concerned. We're really watching inflation here, and if we have to keep rates higher, we will. Well, that's morphing pretty much now into hey, everybody, you got to slow your roll here on the expectations. So Powell has came out and said, the recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve the confidence we want. And if higher inflation does persist, we can maintain our current level of restriction for as long as needed. Bostic, who runs the Atlanta Fed, he came out and said, guys, we might only actually get one rate cut this year, probably at the end of the year. And Mester recently came out and said that she's basically walked back the guidance that she's given the market, and is basically to say that, look, if we cut it all, it's going to be at the end of the year. Now, on the day we're speaking, yesterday, Bank of America just came out with a report saying, hey, everybody, we're probably now not going to get a rate cut until 2025, right? And where I'm going with all this is Powell's higher for longer campaign is now turning into higher for even longer. And why that matters is, this is why the lag effect is so important, is policy acts with a lag effect. When the Fed pulls a lever, it takes a while, oftentimes measured in quarters or sometimes years, for the impact of that policy change to be affected in the general economy. So when the interest rates go up, they start slowing economic growth. Now, there are other things that are goosing economic growth, like all this liquidity we're talking about. But there is this underlying slowing that's going on in the background. As we hang out at this higher cost of debt, the gravitational pull of that slowdown of the economy begins to become heavier and heavier and heavier. And basically, this is one of those systems where time is your enemy, meaning the longer you hang out here and the longer it takes for the lag effect to arrive, when it does arrive, it's going to linger and last for longer. And so I think the great danger here, and I'll wrap it up with this, is that basically the market and most investors have just dismissed the lag effect. That's not going to happen. I argue, and I've got a lot of data here we can talk about if you like, but I argue that no, the lag effect's alive and well. It's kind of been being masked right now by all the liquidity that's been pushed into the system. But that liquidity is unsustainable at these levels. And at some point, the Fed's hand gets increasingly tied to deal with it, because more liquidity leads to more inflation. That's exactly what the Fed's trying to get out of the system. And that's also toxic for the administration as we get closer to election time. So a lot of the things they're doing to try to keep liquidity high, they're going to have to start reducing. So my point is at some point when the lag effect arrives and proves everybody wrong, it says, no, I'm not dead. I just took my time in arriving. The length of time it's taking to arrive means it's going to be pulling the economy down into slow economic growth, potentially recession, for what could be an equivalent period off into the future. And so no matter what we try to do to goose the economy, once things start to slow down, those policy actions have a lag effect too. So we may be stuck in this slow growth, whether recession or stagflation. I'm not entirely sure which it's going to be. We can talk about it, but we could be lasting in that period for a lot longer than the market is currently expecting.
So much to unpack with what you just said. I would like to say, though, people don't look back at history, and I think that's a critical mistake. If you want to see where you're going or plan for future, you have to take a step back or a look back at history. And
absolutely.
I mean, it's been less than 100 years since the Great Depression, and when you look back in time, that's not a lot of time. So, but between the Great Depression and, wars, the Great Financial Crisis was in there. There were a lot of other dips, recessions, the housing market, we saw it. And you can look back every decade or so, we have some type of downturn, some type of correction. The problem is that we never let it fully correct or reset. And we put Band-Aids on it, and we, like you said, we feed them more sugar cereal because it tastes good, and, it satisfies you for that moment. And then you find out just how bad it was for you. But the problem is these bubbles. Look, Adam, you can look at it. I can look at it. I've been saying since 2022 that the housing market is going to crash. I still believe that. There is no way it can't. If you look at all of the indicators, the amount of money that you need to own a home, the expenses, the inflation on repairs, people can't afford it. The fact that millions of people have struggled paying their mortgage payments and have been bailed out to the tune that we're chopping principal mortgage balances that they committed to contractually out of their payment and casting it to second mortgages interest-free. The workouts are crazy. The Band-Aids we're emptying the box. It just shows you, which makes me question, the Federal Reserve manipulates the markets. I mean, that's what they do. But look what you said. The Powell came out and said 7 rate cuts or whatever it was he said, and you watch the stock market take off, right? This type of manipulation is even more dangerous for everyday Americans. Well, for people across the globe, but especially when I'm talking about it, are our people right here in the U.S. And they have no idea just how fast they can go, and their positions can be wiped out, and they can be on skid row and be, 60 years old and not have enough money, what they thought that they could retire, have their pension plans wiped out. I mean, this is crazy stuff that's going on right now.
Couldn't agree more. And well, let's tackle some of those things in order here. So you talk about asset prices in general. So I'm gonna share a couple of charts here if I can. So this is showing the relationship between stock prices and real yields. Right. This is measuring the S&P index versus an inverted chart of the U.S. Treasury 10-year yield. And you can see in the left half of the chart, these were very positively correlated, right? You'll see starting around the end of the year, this is right after Powell basically, dumped a whole bunch of sugar cereal into the breakfast bowl of the market. Stock prices took off where interest rates or yields, on the U.S. Treasury 10-year started rising, right? And so that positive relationship all of a sudden massively diverged, right? And that can't sustain. Basically, one chart, the S&P is sending a sign of exuberance, and the other chart, the chart of the 10-year, is sending a sign of caution. They can't both be right. And what's interesting is over the past, 2 weeks, we've all of a sudden seen that gap to start to close a little bit, right? And that's been with the big sell-off the market had. It was down about 5% over the past 10 days or so, or maybe past 2 weeks. And highly likely these two lines are going to reconverge. And it's just a matter of whether real yields are going to come down a lot or whether stock prices, financial prices are going to come down. And given the environment that we have right now, Todd, where inflation's rising and the Fed is not going to be doing rate cuts anytime soon, and we have a lot of the issues that you just mentioned and more that we'll talk about, seems very likely there that financial prices are going to come down. Now, similar with housing, I'm going to put up one more picture here if I can. I just was reading this the other day that 40% of renters don't think they're ever going to be able to buy a house, right? That's up from 27% of renters just a year ago, right? So that's almost a doubling of people who are saying houses are so expensive, I'm never going to be able to buy one. I'm priced out of the market forever. And what's interesting about this list is you'll see the first reasons for why they think they're not going to be able to afford a house are price related, right? They're too expensive. I don't have a down payment. Mortgage payments are too high. But then right beneath them is regular upkeep and maintenance would be too expensive. Now, you and I have talked about this, Todd, I think last time I was on the channel, which is that not only have home prices gotten to the point where they're out of reach for the majority of home buyers, but just the cost of home maintenance, home ownership, right? Insurance, paying contractors to come and fix the leaky roof and whatnot. Those costs have exploded with the wage inflation that's gone on. So we have this really weird moment in the housing market. It's almost kind of like a Wile E. Coyote moment, but given how transactions have basically collapsed, right? Given that so many current homeowners are sitting on these really low mortgages so that they don't want to move. In fact, many of them will have to downgrade given what they could buy for what they get for their houses right now in this market, that the only transactions that are going on are kind of amongst the already wealthy, right? And that's what's sort of propping prices up right now. That can't last forever. As you and I know, organically, there are transactions that have to happen every month because people die, they lose their jobs, they get divorced and whatnot. And because housing's priced at the margin, that will eventually begin to pull prices down. And actually, if you look at median prices of, let me see if I've got this chart here. I don't have it handy. But median prices of new homes have decreased pretty substantially in just the past year. They've come down 20% since their highs just a little over a year ago. Multifamily and apartment properties, their median price is down 28%. Office properties are down negative 37%. So we're beginning to see some of these corrections already happening. Of course, you look at markets like Austin, they're in a world of pain right now. And I'd love to hear your thoughts on this, but I think they're really offering a glimpse of what to expect coming to many other cities in the not too distant future. And Todd, we're talking all about this just in the context of this higher cost of capital that I've talked about. We haven't even talked about things like, potential job losses, right? Like if we enter a real recession where there's real job losses at scale, then it's kind of like Katie bar the door, right? So yeah, I think even assuming for a second we don't have that type of scenario, we just mathematically have to have lower asset prices for this whole lag effect reason that I've been talking about.
This reminds me so much of what we watched happen in 2005. It started in 2005, the housing crash of 2008. A lot of people, they say 2008 was sort of like everyone could witness it, could see it. But what people don't realize is that new home builders see it first. Mm-hmm. And the reason is because the obvious, they have to sell the home. When you're talking about people that their asset is in their mortgage, their sub 4%, 30-year fixed rate mortgage, when you're talking about people that don't have to move or that would be giving up their house payment and would spend actually more money a month buying something smaller, it doesn't make sense for them. And we also see where generational housing is coming back very strong because mom and dad are buying the house and moving their kids in with them. And maybe it's just mom, maybe it's just dad, but they're using mom and dad's money and they're all living together. This is showing up to be not so great to people that realize they can't live with their parents without some type of separation, like an in-laws quarters. Yep. It does become problematic. Imagine now all of a sudden your mom or dad's telling you how you should be raising your kids. So there's a lot, I'm hearing a lot of stories where that's not so great. But let's just talk about the fundamentals. The numbers don't work. People are broke. They own these houses. If they're one of the 20 million homeowners, or let's just say it's 10 or 15 million of these homeowners that were first-time buyers in the last 4 years that have realized that they paid a lot for their house, and especially if it was in 22 or 21, but they're realizing now that things break. Mm-hmm. And they have to fix them, just like you said, and they don't have the money to do it. But fundamentally, it doesn't work. But when we see now headlines, I think it was yesterday, Sacramento Times, I think that's what it is, Sacramento Times, you would know. They just published a post that said the 5 overpriced housing markets in California, cities in California, to buy a house. That's the kind of headlines that tell me it started. And here's what happens. And I remember when I was building back in 2005, when the headline Baltimore Sun paper said the overpriced Baltimore housing market. That's all it took, right? So who wants to, when you tell somebody, if I say to you, Adam, you're overpaying, this housing market is overpriced. Well, what are you doing? Well, I don't want to overpay. I mean, that was the way people thought, and they're going to think that way again. Yep. It's just taking the lag effect. All of a sudden, that's the kind of article that starts to impact, well, things aren't as great. And now you talk about new home construction. You're talking about 23% median price reduction. They had the worst October that they've had in history or decades, new home builders, since the GFC, for sure. But they had the biggest price downturn in October of 23. They had a little bit of a rebound. They modified the homes by some of them making a little bit smaller house to make it more affordable. But they're sitting in areas like Austin. They're abandoned communities. But my point is that's where it's showing up now. It will get to the rest of the existing home market. Eventually, it's going to show up. Bad shape. We're in bad shape.
Absolutely. And again, I'm going to kind of hammer this concept of the lag effect, right? Where it takes time to arrive, right? But the issue is once you start to see it arriving, it keeps on coming and it keeps on coming.
Speeds up.
It speeds up. So, to your point right now, so here's a stat that I think is just emblematic of what you're saying, right? A recent Forbes advisor survey revealed that nearly 70% of respondents either identified as living paycheck to paycheck, or even more concerning, reported that their income doesn't even cover their standard expenses, right? So, as I mentioned, we have this housing market where we are dramatically shrinking the available pool of buyers, right? And nobody really cares at the moment because prices on average are still supported, right? And that's sadly just the way that markets largely tend to operate is that people tend to not want to care unless they have to, right? So it's not going to be until the contagion from Austin starts creeping into more and more cities where, people start getting the memo of, okay, first off, all the buyers that are at the margin where it's like, I could buy if I really stretched myself, but why would I? If prices now are clearly starting to come down, I'm just going to wait. Time's on my side, right? Then you have the sellers, right? Who right now, they don't want to sell. It's not in their interest to sell, right? Let's all hang together in solidarity. But if asset prices start coming down, like they're starting to worry a little bit more about the future of their 401ks and what they have available to them for retirement, or for many people, their house is their retirement, right? That home equity, that's for a lot of people, like that's what they think is going to fund their retirement whenever they sell. If they start getting worried that prices are heading down in the future, well, then they've got a first mover advantage to bolt from the herd, right? Let me sell now. Yeah, I'll take a 5% haircut or whatever, but better than hanging on and potentially getting a lot less. And then that starts a panic, and that starts to feed on itself, right? You're shaking your.
You're right on the money, man. I tell you.
Yeah.
So here.
So my general point here is just that, like, we have all this dry tinder, right, in the housing market, right? We've got this one huge mathematical disconnect, right? There's the seesaw. Let me get in the camera here. There's the seesaw, right, where interest rates go up, prices need to come down. That didn't happen this time. And again, it's one of those reasons why people have just disregarded the lag effect this time. Oh, it's different. It doesn't apply in today's circumstances. So we haven't had that correction yet, but mathematically, it needs to happen, right? Then we've shrunk the available buyer base. Of the buyers that we have, they're increasingly getting pressure from cost of living. So their ability to afford houses at any price is starting to go down. We have, we keep being told how great the jobs market is right now. But that's if you look at the official data. And there's a lot of I'm sure you've probably seen some of the recent articles, Todd, that show that initial jobless claims have come in at the exact same level for 5 out of the past 6 numbers in the series, right? Clearly some sort of goal-seeked number from the guys that are writing the models at the BLS. Whereas if you trundle over and you look at things like Challenger and Gray's layoff trackers, or if you look at the WARN notices, which companies are required to give if they have above a certain number of employees, saying, hey, we're going to do layoffs 6 months from now, those have been exploding all year, right? So we're already seeing a lot of other data that suggests that the ability of the general populace to afford anything is getting more and more compromised. And of course, if those layoffs ever get to the point where, they start entering recessionary levels, then demand for housing is going to have to take a hit. So we have all this dry tinder that we've been talking about. All we need is a match. And that's, kind of, you were talking about 2008, like there were lots and lots of warning signs building up to 2008. But you know what? Housing still pretty much hung in there. The markets hung in there just fine. It wasn't until Lehman surprised everybody. And that was the match. And then the whole thing just went up. I think we have an increasing danger of that type of scenario this time around.
I'll give you my opinion on why I think that the home prices are still going up, even though not to the tune of what the headlines are telling us. But first, I want to talk about the jobs reporting. And I'll just ask you, are you going to trust your job stability and strength of the job market by the job that they post that is not yet filled, or the company that cut 1,500 employees?
Right.
which one holds more strength, right? Obviously, I'm going to trust the layoff more than I will, when a tech company publishes 50 jobs that they don't ever fill and they never even call the people back when they fill out their, send a resume and create cover letters, and they say, I never heard, I've applied for 100 jobs and I haven't heard back from one. So I'm not trusting that. But when you talk about asset prices, and you're right, I mean, we are one step away from watching this whole thing implode. And why haven't higher interest rates worked? Why haven't they really knocked the asset price down? And that's a big question that I hear from people all the time. We were at 7.5%, 30-year fixed rate mortgage now. Obviously, the prices didn't come down, even though 7.5 historically is not a bad mortgage rate in 5 decades. I think it's 7.7% has been the running average. But let's just say 7.5%, you would think coming from 2.75%, you would think that this would be devastating to asset prices, the housing market, but it hasn't.
Let me just interrupt. If 2 years ago they had told you and I that mortgage rates were going to jump up to that, we would have said, oh yeah, prices would cratered.
It's going to implode. The reason why it hasn't is because the buyers believe that the asset prices are going to continue to go up, and they believe that the interest rates are going to drop. They may be sadly mistaken, because if the asset price drops, they're not refinancing at a better interest rate. So you may get back to a 5% mortgage rate and you're at 7.5 now. But if your asset price drops, if you don't have $150,000 plus closing costs to go into a new loan, you're not going to be able to refinance. So I think that people, they're just, they're not, the exuberance is outweighing the lack of inventory, and the over exuberance is outweighing the potential for disaster.
Absolutely. So I was interviewing Jesse Felder not that long ago, and he calls this extending the unsustainable. And he sees this in a lot of other assets, but housing is a classic example. What you're talking about is a classic example of this, right? Which is just extrapolating today's trends and just pretending that they're gonna head out there forever. And I'm really glad you brought that up, because one, back to my previous comment, we are going from an era of higher for longer to high or higher for even longer. That's the point I hope folks take away from this discussion here, which is that this higher cost of capital is going to last longer than anybody thought it was going to, even just a couple of months ago, right? And so if you're waiting for the cavalry to arrive, like you said, people are expecting home prices to continue to go up and interest rates to go down. The interest rates to go down part is not going to happen on the timeline that the housing market right now is currently expecting it to. And when it does, this is the second point, it is likely, unless we're in a huge crisis, which we might be, but if not, it's likely to happen at a much slower pace when it does start happening, to ride to anybody's rescue. So let's say the 3 rate cuts we were supposed to get this year, we don't get until next year. So now it's the end of 2025, and mortgage rates have come down from 7 point whatever. What are they right now, Todd?
Well, I mean, it depends on your credit score, but you could be at 8%.
Okay.
And if you don't have a 700 credit score, I mean, unless you're paying points, I mean, you're going to be north of 7.5% right now. I mean, it's gone up.
So if they go from 7.5 to 8 to 6 to 6.5 by the end of 2025, that's not making a huge difference to you, no. Right? To your point, right? It's not, that's not supportive of, housing prices that should be vaulting ever higher from that. So, the point is that the market is largely doing a lot of magical math right now. And Peter Atwater, well-known behavioral economist, and he focuses on sentiment. He focuses on sentiment because it's so important. He says, basically, markets, they reach these tipping points in sentiment where, like right now in the stock market or in housing, the bulls are in charge, right? And prices will go up and sustain right up until the point you switch to where there are suddenly, might only be the difference of 1 or 2 people, but you go from being net bullish to net bearish, or net optimistic to net pessimistic. And then once you reach that tipping point, then the activity really has the potential to start building momentum at an increasing pace in the other direction. And that's always what catches the market by surprise. And I think, from what I hear you saying, I think you feel like the housing market is just waiting for that moment where you get to that magical number where there's just all of a sudden just a few more people who think, you know what, I don't think these prices are going to keep going up like this. In fact, I'm now worried they're going to start going down. Then the entire tenor and the entire activity in the market starts changing.
Adam, what about this scenario? What if prices just flatten out? What people don't realize is, and depending on which state you live in, transfer and recordation fees can be quite costly. And when you sell real estate, we like to say that you need about 10% equity in order to come out flush, right? To where you're not bringing money to the table. Now, if you put a lot of money down, it doesn't matter. You may pay off your mortgage after you close, but that doesn't mean that you didn't lose money, lose the down payment money. So let's just say for the next 5 or 7 years, or maybe 10 years, this could be a decade-long flat line at the very best case scenario, where we see 0.5% growth, price growth. Let's just take that scenario. Most people don't stay in their home more than 7 years. 7 to 9 years I would say 9 years would be the absolute outset to that. So regardless of whether we take this big asset price dip or not, if it just flattens out, this would still be devastating for a lot of people that will have to sell, especially for those that want to sell within 5 years. And we take our youth, we have to look at the pattern of these first-time buyers. They went to universities. They moved every single year that they were in college. Maybe they started out in the dorm. Then they, got an apartment with their buddies. Then they wanted a house. So they moved around a lot. They're not used to staying in one spot necessarily. They think that this is a starter home. They get there. They go, oh my gosh, it was limited inventory. I don't like the neighborhood anymore. I don't like the area. I don't like the traffic noise, whatever it is. And they want to move. They're ready to go. We are already seeing where people bought homes in 22. They want to get out. I just had a client. We're selling their house. They moved back home. They're like, we're out of here. They bought it 2 years ago. So when you look at this type of behavior, I think financially we're underestimating the devastation of those that made bad mistakes over the last 4 years.
Well, totally agree. And what's terrible about bad policies is it always ends up damaging those who can least afford it. Right? It's always the most vulnerable that get hurt the most. And in this case, it is our younger populations. Like I said earlier, most of them are renters right now still, and 40% of them think they're never going to own a home at this point in time, right? Those that could buy a home, a lot of them got caught up in the pressure of the FOMO that followed all the stimulus during COVID, right? And you're going to get pressed out of the market if you don't get in now, so they all scrambled to. And to your point, they're waking up with a hangover at this point. Wow, I probably overpaid. I probably couldn't afford this home, and gosh, I don't like the neighborhood. I don't like the house, or a lot of cases, people thought that they could work from wherever because we were moving to a work from home economy, and they moved to the promise of some new city, and then they realized, my gosh, I don't like this place nearly as much as I did. I have realtor friends up in Idaho, and I was talking to them back in 2022 when this phenomenon was going on, and they were like, yeah, we've seen this before at previous booms up here, and we always say just give them a winter, and we know that after one winter a good chunk of them decide I can't hack it here. This is too much snow, and they end up having to leave. So you've got all that going on, and so even to your scenario, like even if we just hang out here for let's say it's a lost decade, right? And we wait for value to catch up to prices over the next 7 to 9 years or whatever. Remember the reason, at least right now, the reason why the Fed isn't going to be lowering rates is because inflation is remaining sticky. right? It has an inflation problem. So, even if home prices aren't moving up anymore, even if you're a homeowner, you're getting continually punished by this increasing inflation, right? So all of a sudden, if your house isn't appreciating anymore, but your cost of living keeps going up, on a net basis, you're worth less every year. And again, back to the people who get injured the most are the more vulnerable. If you owned your home prior to 2020, odds are you're sitting on a good deal of equity and you're sitting on a really low mortgage. But if you bought after 2022, you're not. In fact, you might be sitting on losses and a pretty expensive mortgage, and then you add this cost of living into the mix. So it's really rough on the more disadvantaged cohorts. And the reason why this is really meaningful to me, and Todd, I think you're the same way, is increasingly my concern. This is a very high level after years of doing what I do, talking to people about the economy. I'm increasingly concerned that America is, in a lot of the West, but America is turning more into an aristocracy than a meritocracy, where the promise of, hey, you work hard, you can grab that brass ring and live the American dream, that's getting more and more just realistically out of the reach of more and more people, and that the spoils of the system are concentrating into fewer and fewer pockets. And from a home perspective, and you referenced this earlier, like if you're a millennial or certainly a Gen Z, the biggest determinant of whether you're going to be able to be a homeowner is how wealthy your parents are, right? And it's not fair, right? And there's a lot I wish we'd be doing differently. I hope we do decide to make some policy changes in the future, but we can't hold our breath for that. We have to live with the world that we have. And so this is sort of one of those things, Todd, where I think people like maybe accuse us of being perma-bears or whatever. I'm not trying to be. I'm just trying to literally call it as I see it and help people understand, okay, if that's the case, then you need to work even harder and even smarter with your wealth to be able to try to be one of the ones that succeeds in getting that brass ring.
Wouldn't it be better to just be truthful with people and say, look, the inflation sucks, it's not going away. We can't just bail you out. We can't just print more money. But let's talk about solutions. Maybe we need to teach people to get their side hustles going. Maybe they need to realize that they need to be more motivated than throw their hands up in the air. And a lot of this would just be being truthful with them like we're doing and telling them, hey, look, you want to say we're doomers. This is reality. If you look at what we do, Adam, and you can sit there, and this is the problem with politics right now. I've never seen a time where people hate each other more, the left and the right, and you can't talk about anything because, and we watched, through the pandemic, we watched families get broken apart. But if we actually taught people how to get through this, look, we need to deal with this problem, right? But the problem with that is that doesn't help the elite. That it goes against their narrative. They want us to be in this position. They want us to be arguing with one another. They want us to be financing our groceries. That's the only thing I can put together. Because if they didn't, they would be coming out with more solutions to teach people. You talk about financial literacy all the time. We don't do the right job teaching people how to be responsible with money, right? We allow these banks to prey on our youth by giving them credit cards when they don't even have, they're in college, and Discover cards, sending them applications and giving them, $1,000 credit limits, and they don't even have a job, right?
Yeah. So I've got two daughters in college, and that's the first thing you get when you arrive on college and open your mailbox for the first time. It's just stuffed with credit card offers. Yeah.
Yeah. So when you look at, so let's talk about the people, because you said something about the equity that they have in their homes, and you're right. But if you purchased your home in 2019 or before, man, you were really celebrating at the pricing of what your home's worth right now, right? But you also made a valid point. They're still stuck with the inflation of today to fix things. So they're not fixing it in 2019 prices. They're not spending $8,500 for their new furnace. They're spending $25,000. for their new HVAC system. So when they were buying it in 2019, their job didn't necessarily go up 40 or 50% in take-home pay, or gross pay. So what do you think as far as, practically speaking, do you think employers are and I want to get your opinion because you were talking about contraction of the money supply. Yeah. I don't think people pay attention to that. I don't think our Federal Reserve pays attention to that as far as in their projections. Maybe they do. But when you talk about contraction of the money supply, you're also talking about contraction of the credit supply. And that's affecting employers. And that will affect their ability to give raises to their employees. So kind of what is your prediction if you say, all right, let's say that we can soft land this plane, and I know you're not saying that, you don't believe that, but let's just say, or no landing at all, and we just continue and like, wow, this is great, and the asset prices don't take a hit. Well, then with that, in order to sustain that, our jobs market has to do really well. Our employers have to be profitable, and so much that they continue to give raises, great raise increases for people to continue to afford the inflation. Is that practical?
I don't think so. For it to be, I was going to say sunshine and roses, but just for it to continue to be summer, right, forever, we need to have sustained economic growth above what we have right now to basically drive corporate profits and then drive wages, right? Growing real wages, right? The global economy has been in rough shape recently. The U.S. has actually been the best of the bunch. But the U.S. economic growth is slowing. And what are higher for even longer interest rates going to do? They're just going to slow economic growth even more. So even without something systemically breaking under these higher rates, just sort of status quo, the economy is going to be growing less and less. And at the same time, to bring back our old friend, the lag effect, corporate America, like a lot of homeowners, they levered up with cheap credit when cheap credit was available. But that's now coming up for its maturity is now coming up. Corporate America faces this big maturity wall over the next couple of years where almost $1 billion is going to come up for maturity this year. More than $1 billion is going to come up in 2025, similarly in 2026. So these companies are going to see their cost of debt jump, in most cases more than double, right? So what are they going to be able to do when that happens? Well, that's going to drive up their interest rate costs, their cost of debt service. And they're going to have to make up that difference somewhere else in the business to cut costs, right? Well, pretty unlikely that they're going to be able to give really generous wage increases in that. In fact, they'll probably be freezing wages. They might even be freezing hiring. They might even be laying off workers. I think it's probably going to be more the latter as this goes along, right? So realistically looking at it where we're going, it seems like the opposite of the conditions we'd need for that eternal summer, right, in the housing market that you're talking about, or just in the general economy that you're talking about. And we're already seeing, we had 2 years of negative real wage growth. As inflation really got going, we did start to see that creep into wages. We have had positive real wage growth for about the past year, but the pace of that, the rate of that wage growth is declining at this point in time. And so, if we start getting into the period I think we're going to get into because of this higher for longer era that we're looking forward at now, corporations are going to have to start pinching. And as the cost of living continues to rise and people don't get relief on that, they're going to be contracting their consumer spending anyways. We have a 2/3 driven consumer spending GDP. So as consumers contract their spending and as the corporate maturity wall forces companies to, freeze wages or start firing people, that's going to increasingly contract consumer spending. And of course, that begins to create a vicious cycle where less consumer spending means even less corporate profits, which means they have to lay off even more people. And then people they lose their income or they get scared they're going to lose their income. So they tighten their purse strings even more and it starts heading downward, right? So look, no one has a crystal ball. Is it exactly going to play out that way? Who knows? But from all the experts that I talked to me, that feels like the more probable route ahead of us.
I'm not an economist, and I learn more from people like you. I mean, I'm a real estate guy. I'm a contractor by heart. I mean, that's how I made my living, my adult career. I spent building things and creating things, doing labor jobs that a lot of people nowadays don't want to do.
Hey, you're the pumping heartbeat of the economy, my friend.
I tell you what, and now we're going to find out where the blue collar workers actually they're going to be more needed as time goes on because people don't know how to fix anything. But when
they actually do real work too, right? I mean, having spent a lot of my career in white collar, paper pushing, Excel modeling, PowerPointing, careers. There's a lot of jobs in mainstream corporate America that just do not create any real value.
And you need to, but it's important that you stay well and healthy because what a lot of people don't realize is when you make a living with your body, working every day, going out and doing physical work, it's very important that you keep that body in tip-top condition and health because that is your, and that where you can do a white collar job when you get into your, older years, but it's kind of hard to go out and lift. I mean, do physical labor 10 hours a day. But, when we talk, and so with saying that I'm not an economist, I'm a practitioner. I know when things don't work, right? I've been studying for 35 years profit and loss of my own company, right? Financial statements, balance sheets. I mean, I get it. I know what you need to do to remain profitable in order to offer higher paying jobs. And one of it is not wasteful spending. You have to be smart with your spending. But when I look at the Fed and I say, and one of the things that I believe is that when we talk about higher for longer, they're in a position right now where they've kind of found a sweet spot. Because they need inflation not to be at 2%. They need inflation to be at 5%. Because if they don't reduce the debt on the balance sheet for the United States, we're not going to get foreign investors to invest in our debt, right? If they see that we are completely exploding and this debt spiral is a death spiral, and so we'll lose the foreign investor money. So we have to do this quantitative tightening, right? I mean, is that correct? I mean, doesn't the Fed want inflation?
The Fed wants manageable inflation, right? It wants the sweet spot inflation where, yes, inflation helps the Fed because it lessens the cost of the interest, the real cost of the interest payment that they need to service the debt. But they don't want too much inflation for a couple of reasons. One, because that spooks investors, and investors then demand higher interest rates on the debt, right? So that it makes the debt problem even worse. And in parallel with that, you just have a huge domestic issue. Right?
Investors buying what?
Oh, investors buying the debt. So one of the debates that's going on right now, which is if the Fed can't get inflation under control, like let's say it's a year from now and inflation's at 4% still, maybe even going up to 5%, whatever. There's a lot of people that think the bond vigilantes, it's an old term, but that they'll show back up and they'll say, you know what, Fed, you don't know how to get inflation under control. We've lost faith in you. And therefore, if we're going to buy your treasuries, we want even higher rates of return offered to us, higher yields offered to us to make up for what we think we're going to lose in future inflation. Right. So it actually begins to make the debt expense issue even more problematic for the Fed.
Interesting.
And of course, like I said, when inflation's high enough internally, you get all sorts of domestic pushback and issues, and we've been seeing that over the past year. So I don't need to talk about that for anybody.
Do you think we can trust the numbers, the inflation numbers? I mean, when they say 3.1%, I mean, I don't think it's that low, is it?
No, their numbers have been woefully beneath what I think the average household experiences. And will that continue to be the case going forward? I think absolutely. So I think they'll underreport it. I think they want nominally, they say they want nominally 2% inflation. I think they're pretty happy with 6 to 7% sort of shadow inflation in the world. And I think that they can use those numbers to kind of convince the rest of the world they've got inflation under control enough, but it's helping enough of the the cost of the true cost of the debt, that it's working towards their means. But a lot of people give the Fed way too much credit. The Fed has a crude set of tools. It's basically just got like two big levers. It's got interest rates, and it's got whether I'm going to do QT or QE, or some call it a bazooka, right? It's not a surgical instrument, right?
They have a saw and a hammer.
And they act with these lags, right? So it's not like a scalpel where you can just get a very fine result. You kind of pull it and then you wait a bunch of months and see, did it kind of have the impact that we want it to? So, but you raised two things that I think are worth talking about. One is, we don't need to get too into this, but we've been talking a lot about the Fed. Honestly, I don't think the Fed is really as much in the driver's seat these days as I think Congress and the administration are. I think fiscal policy is having a greater impact on what we're seeing happening on the ground right now than monetary policy is having. And you gave mention at the beginning of this discussion to an interview that I did recently with former Federal Reserve. It was the CEO of this Kansas City Federal Reserve. This is Thomas Honig. This was one of my top favorite and I think top most important interviews I've ever done. He ran a regional Federal Reserve Bank, but he also was a sitting member of the FOMC during the Great Financial Crisis. And when Ben Bernanke was rallying, the board of the Fed to vote for QE, Honig was the lone dissenter, and he holds the record at the Fed for the longest string of dissenting votes. And they obviously decided to go on and do QE anyways, but Honig was coming out and saying, hey, look, this is going to contribute to an explosion of debt. It's going to eventually, bite us in diminished purchasing power of the dollar. It's going to contribute to wealth disparity. Everything he predicted has come true, right? And so talking with Dr. Honig about the Fed was completely eye-opening. And folks, I'm sorry to give a shameless plug, but if this interests you at all, highly recommend that you go watch that video. I didn't intend it to be like, hey, we're going to tear down the Fed in this interview, but I did warn him at the beginning that I've got a lot of pointed questions that my viewers have, and he said, fine, ask me anything, and kindly answered every question I asked very clearly and in detail, and basically said, to a certain extent, not in his words, these are my words, but it's as bad as we all think it would be. But he said, right now, actually, the Fed policy is probably where it needs to be right now, given the state of the economy and inflation and all that. But fiscal policy is off the rails. And he said, in the long picture, this all ends in basically a destruction of the purchasing power of the dollar and all the other major fiat currencies, because all the other central banks and nations are basically pursuing the same policies. He said, to avoid that in the near term, we really need to get our fiscal house in order. And I said, okay, great. Well, what are the odds of that? What are the odds of our politicians actually agreeing to tighten their belts because they can see some of the longer term issues that you're raising here? And he said, oh, pretty much zero, right? So
that's accountability.
Yeah, it's accountability. And you were sort of saying this earlier about how our politicians are just not, they're not acting in the interests of the populace. And it's true. I mean, we very much have a captured form of governance by special interests. Talking to Honig, the Fed is supposed to be independent, and it holds that independence up, waves it to the world. But Honig said, oh, no, by far the two voices that speak the loudest in influencing Fed decisions are coming from Wall Street and coming from Capitol Hill. And even worse, he said that a lot of times the Fed will act for optics and then agree, let's make this decision, let's run with it, and we'll figure out how to make it work later, right? So, we all would hope that the Fed is truly independent. We all would hope that it's making very specific decisions with the actions that it takes because it has some sort of master plan to bring things to some sort of surgical outcome. And Honig, he had some positive things to say about the Fed, but he basically said on average, he's like, yeah, no, the Fed is definitely flying by the seat of its pants way more often than it should be.
when you say the influence is coming from Wall Street, or when he says that, Wall Street and Capitol Hill, specifically with Wall Street, what does that look like? And how
Corporate interests. It's
banking, bankers' interest, J.P.
everybody.
Morgan Chase.
Yeah, I probably should have said corporate America more specifically, but absolutely, the banking industry, but also from, all the other kind of corporate cartels that are trying to preserve their advantage and advance it, right? So, sadly, it just seems that, the question we would all hope would be on everybody's mind, which is how does this best benefit my constituents, gets overridden by, okay, the big donors that are influencing both my reelection chances as well as the fat, board seat I'm going to get once I'm done here. Those tend to be in the driver's seat. And you and I were talking before we turned the camera on here about, the recent package that just got passed for, all this bloat for a lot of, overseas adventures that may or may not have American interests at heart, but basically a big goose egg for a lot of the really important domestic issues that so desperately need attention right now.
Yeah, House approves $95 billion aid bill for Ukraine, Israel, and Taiwan.
Yeah, and I'm not diminishing the importance of preserving America's geopolitical influence, but I know a huge part of that campaign there around that recent vote was, okay, what are we doing about the broken border here? We've got a massive need to come up with some sort of strategy and stop the hemorrhaging there. And it basically got, effectively nothing in that bill from what I understand.
What about, when we talk, man, it's crazy. We're spending, like you said, we're dealing with, we don't even know who's coming across the border. We hear stories about all these terrorists coming in, and this is crazy what's going on. I don't understand it, really.
Yeah, you and I were talking about, before we turn the camera on, how it oftentimes feels like we're living in a world that's written by the Onion. So hugely sensitive topic, but we can't afford to not talk about it because it is so important socially, economically. It's an elephant we can't afford to ignore in the room. And like you, I think we can have a respectful, curious-minded exploration of this without slandering anybody or any groups, right? And I want to get back to how it relates to real estate in just a second, but just to be super clear for folks on this topic, pretty much everybody in the U.S. immigrated here. Unless your ancestors were Native Americans, everybody else that's here is a Johnny-come-lately. My 2 cents on this, and I've talked a bit about this on my channel, is, look, I just think you need to have an immigration strategy. Right, that's what you need to start with. Right, you have to have a plan. Okay, how many people? There's 8 billion people in the world. Right, pretty much all of them want to live in America. Right, we probably can't handle 8 billion people. How many people can we realistically handle, and what pace do we want to get on there? What track do we want to get on there with? And so, how many people a year is that? Okay, great. Once we have that number, what skills do we want to have? Right? What type of skills do we want to bring into the immigrants? Great. And then we'll have some percentage in there for the amnesty and hard luck cases, right? And then we just come up with the numbers and say, okay, what are they? And then we basically resource our borders to the point where they can affect that strategy. Bring in as many as we've said we wanted to bring in at the types we want to bring in, and tell everybody else, sorry, no room in the inn this year, for the rest of you, maybe next year. Right? That makes a ton of sense. We're so far away from that right now. It's crazy. And that's why we need to be having this discussion about how do we get to something that works in the national interests of the country that's humane and respectful to all parties. Right? Okay, that being aside, so these bodies that are coming in at the volume they're coming in right now, they have to live somewhere. Right? So they're going to have some sort of economic impact on the real estate market in some way, shape, or form. Sounds like you're not seeing it in the real estate for purchase market yet, and I would agree. I wouldn't expect, like I said earlier, we'd see it there. But could it be pushing up the rental market to a certain extent?
Well, Adam, I have to ask the question: who's paying the rent?
Right, and maybe it is a legal resident that it knows these people and is working with them as sort of a front. I don't
But do
know.
they
And
have?
maybe there's a
But do
lot
they
of
have a job? Who's hiring them?
yeah. Well, good question. I mean, I live out in California, where obviously there's a lot of these undocumented workers that get work because it's low paying work, hard work out there in the fields. And I don't know if they can convince a landlord to rent to them, but they have to, because they have to live somewhere.
They have to pay the rent. And so that's the bigger issue than if we're not making a pathway to citizenship. So are you going to come down on the employer for hiring undocumented employees? That's the bigger question. Are you going to pick and choose what industry you will allow it in? So if you're not giving somebody a social security card, or you're not giving somebody the ability to get a job legally, that's the issue. That's the sensitive issue. So you let these people in, but then are you going to come down on the employers for hiring them one day, come stormtrooping their business and fine them or put them out of business because they have to work? This is the bigger issue.
It is the big. So yeah, and sadly, I don't know the answers to this question. I don't have the data, but they got to live somewhere. And if they're not in a living arrangement where they're basically able to pay their way, then I guess they're living off the state, right? They're living in these subsidized hotels or these,
which they don't want to do. I can't imagine that they want to do that.
No, and of course we're seeing more and more articles about these recent immigrants being placed in schools, and then there's clashes between the immigrants. And nobody's, to your point, like nobody's happy with the solution. And if it continues at the volume that's continuing at, it's only going to get worse and worse and worse. So, again, like I said, we have to care about this because it has both social and economic ramifications. So we can't afford to not kind of directly talk about the topic. But to our discussion here, there's still so much that's unknown about the data. That's what really scares me is we just don't know the extent of the issue because we don't have a lot of good data to rely on.
Yeah, 100%. And the other thing is, we could probably have a conversation that would be really in depth on this topic, but it might not be good to talk about, right? So,
yeah, well, sadly,
you kind of tiptoe through the tulips here. You know what I mean? It's like
it's the world we're in, and you probably saw this article the other day. There's, we're in this sort of minefield, society where there's this company. I think they're called Sheets. Where they've just been sued by the government because they don't hire people that fail a criminal background check, and because that disproportionately, like if you look at the people who fail the background check, there's certain minority groups that are caught by that more than other minority groups, and basically it comes down to the fact that this company, which basically has a lot of convenience stores. Right.
Sheets. I've heard. They're big on the East Coast.
Okay. So yeah. So they're just like, well, look, we don't want to hire people that have a track record of basically breaking the law and stealing, and essentially they're kind of getting sued to a point where it could put the company out of business simply because they don't want to hire proven criminals, right? So, look, this story is probably a little more nuanced than that, but it's again the sort of crazy world we're in right now, where decisions that you think would be just common sense can actually put a company at existential risk.
Yeah, again, a lot of topics and a lot of things that we never had to deal with, 30, 40 years ago, and we've just kind of. We've kind of glazed over. I think the immigration issue, all the presidents have, or when they're campaigning recently, probably since Bush, have really talked about some type of immigration reform. And when I talk to a lot of people, they say they really haven't done anything. There is no real clear There was the Dreamers Act, and there were all these, different programs, but none of them really went very far. And there is no, like you said, there's no stopping the influx and dealing with what we have and trying to come up with a good pathway to citizenship. And I think a lot of people are really upset about it. And when you see these bills of 95 billion aid for Ukraine, and I'm not saying, look, it's not my place. Do I want to see our children on battle lines, battlefields, and things? No, I don't want to see any of that. And I think we're in a lot of situations. We're really we're playing with fire in some of this, right? And in a very critical time. I'm not saying that we shouldn't be giving aid. I'm just saying that why aren't we focusing on the issues that we have here in the U.S.? Why aren't we building more affordable housing? Why aren't we cutting red tape in order to put the fire out that we have here in the U.S.?
Well, I think it's because we have this perverse set of incentives. And I mentioned earlier that a lot of Capitol Hill is kind of captured right by these special interests. Also, too, we have a political base that's not only old, right? I mentioned the gerontocracy earlier, but it has cut its teeth through its entire career on how do I divide up an ever-growing pie, right? It's been a great time to be a politician because pretty much every year you have more money to spend, right? And even when we had this last crisis, what do? Right? Rather than say, hey, look, we're in a crisis, we should spend wisely. Instead, we just said, oh, let's just give tons of money we can't afford to everybody, right? That is the musculature of our political team, our political players, right? So if we are entering an era, like I think, for all those reasons we talked about the lag effect and the higher rates for longer and stuff like that, that is an era, especially if it lasts long, like I think it may, where what you need in your decision makers is somebody who knows how to intelligently allocate a static or shrinking pie, right? And so you can kind of make the argument that we have exactly the wrong people in the job right now for what the needs are, right? So for them, it's always easy just to say, oh yeah, Ukraine or whatever, something else that I can get a cut of, these monies we're spending. Sure, I'll write that big check. And even when we go back to the stimulus programs and stuff like that, like Todd, you and I as humans, our brains can't really fully understand how big $1 trillion is. And that used to be kind of a magical number. You talked about billions and hundreds of billions in DC. In fact, I can't remember who mentioned it, but somebody said $1 billion here, $1 billion there. Pretty soon you're starting to talk about some serious money. Well, we kind of flipped that in order of magnitude, and now that's become trillions, right? And we basically, between the monetary and fiscal relief packages in just the US alone during COVID, we spent over $11 trillion. I'll tell you this, nobody can understand how big that is. And the ramifications of the interest debt service costs on that and all the distortions that makes in the world. It's one of the reasons why we're so surprised by all the actions going on right now. And honestly, why the recession hasn't arrived yet, I think, is because we put such an unbelievably big pig into the python. It's just been taking a lot longer to exit than we thought it would, right? So we have these people making decisions who just really don't understand the implications of the decisions they're making, and they have these perverse interests. So it's really a bad, toxic combination. Let me just make one more point before I forget it, because this is important and it sort of ties to both the economy we're talking about and the immigration thing we're talking about. I interviewed a demographer, a guy named Chris Hamilton, and you might not recognize his name, but he runs a website called Economica, and he produces a ton of charts. I'm sure you've seen them, Todd. And he focuses a lot on debt and demographics. And basically, he has shown that the U.S. population is its growth is fast declining, right? And that's very concerning for a bunch of reasons. One, we're just having families later in life and fewer children per household. That's a direct result of younger generations feeling like their future prospects are not very good, right? They just don't feel like they can afford to, right? That's a bad thing. Not only is our population growth shrinking, but when you look at what drives an economy, is the size of the working group population. That's the 25-year-olds to 54-year-olds. That cohort in America is shrinking. It's actually fewer people on a year-over-year basis. So we have fewer people in that cohort. That's only going to get worse as time goes on. So he estimates that, hoping I got these numbers right, but if you look at natural-born Americans, that population base at current trajectories is set to start shrinking around 2035, like to be a net decline. And then if you add immigration into the mix, I think that extends us out to about 2050, but then America total population starts shrinking after that. That's at current trajectories, right? So what that does is it raises a lot of alarm bells that say, hey, if you want our current economic system to continue to work, the way it's currently set up is that it has to grow over time. If you want that to continue, we have to get our population on a sustainable growth track, right? And that actually makes immigration really important, right? I mean, obviously, we want to try to come up with policies or incentives or just make things good enough here that the people who live here want to have families, right? But the cruel math says, hey, you need immigration. It's going to be, if you want the current economic model to continue, you actually need immigration to fill that hole. So we really need a good immigration policy. Like, we need that if we want to have our economy to have the future we want it to have. Now, maybe it cracks open a debate at some point in time. Is there a different economic model that we want to have? And we don't have enough time to get into that. But solving immigration is really, really important to our own self-interests, let alone dealing with kind of the particular pain points that our current lack of one is creating for us right now. So again, it just underpins the fact that, like, we need to have much smarter decision making and much more courageous decision making to say, hey, look, let's get everything that doesn't really matter off the table, and let's focus on the key long-term crises that are facing us and try to get those things to a point where, we're serving the long-term interests of the country. But as you and I have said many times so far, we just don't have the right cast of characters right now doing that.
Well, if we want to be the largest buyer of GDP in the world, we have to continue to allow people to come in to the country. Like you said, I mean, when we're not having children because we can't afford to do it, or you have two people working two jobs to make ends meet, who's raising the kids? And then what happens is childcare is so expensive, especially for infants. So now you're going to spend $1,000 a week dropping your infant baby off so that you can go make $800 a week. I mean, those numbers don't make sense. The equation doesn't work. But when we're talking about, we don't make anything here in the U.S. I mean, we're spenders. And and we want everything done for us, right? So we're not building anything here. I think if for long term, we need to start doing more manufacturing, bringing the manufacturing jobs home, and I think that the immigration needs to be a legalized path. You can't just let people pour into the borders. I mean, look, I don't know it firsthand. I haven't seen buses going down the street, but you hear it. Where they say, these governors are busing them up and dropping them off to DC and all these, and saying, good luck, have a nice life. I mean, that's not a way to deal with things. We need to be focusing on this more. This is a political issue. It's a political football. It's dangerous territory to tread in. I mean, the cancel culture is real. The divide is real. I mean, Adam, as we kind of, and maybe you don't want to talk about this, and it's fine if you don't, because I try and keep politics off my channel. But we're coming down to the wire. I mean, November is fastly approaching. Yep. I mean, what do you think? What are the implications of, or in your mind? Like, what are your worries when you think about? Okay, is it RFK? Is it Trump? Is it Biden? Is it whoever? Some people say. I've heard people say, they think Michelle Obama is going to jump in at the last minute or whatever, and what are your thoughts on what will happen in November, and what do you think the implications would be
Of whoever wins.
of whoever wins.
Okay. Let me get to that in just a sec, because you mentioned a couple things. I'm going to tie a few more dots together. So you talked about how we need to have a path for the people that are coming into the country to find gainful employment in a way that makes their lives better, makes our economy better, right? Strengthens us, right? And knowing who they are is obviously an important part of that, essential part of that. So I want to combine that with the challenges that younger generations have right now to get gainful employment, right? Even though we're told unemployment's super low and there are all these, more job openings than there are applicants, that is increasingly flying in the face of both some of the data I mentioned earlier, but also just anecdotal data. And again, I've got kids college age, one who just graduated college. And so, I talked a lot about kids at this cohort who are saying it's actually really pretty hard to get hired these days because most companies, they're not really actively hiring. In fact, let me just tell you this thing. I talked to somebody the other day who said, I've been talking with recruiters in HR and get a lot of candidate intel from them. So this is somebody who's actually doing consulting work to HR recruiters. She said they're posting jobs that do not really exist or are not currently open for hire. It's just for optics. She said the economy is not in alignment with the data and the labor market. And the labor markets here in the US is absolutely, quote, frozen solid. She's been in this field for 28 years and has never seen so few hires from cold applications and such limp employer hiring interest. Right. So part of that's economic, just where the economy is right now. But I think an increasingly part of this, and we haven't touched on this yet, but is the whole AI boom. Right. We've made it so expensive to employ people. And I railed about this before the AI boom, in fact, even before COVID, that we've been giving companies a huge incentive to try to shed as much human labor as they can, right? And to outsource, to automate, and to now with AI, adopt AI as fast as they can. And so, we all see this when we go to the grocery store and there's self-checkout now, right? You go to the McDonald's and there's kiosks, right? Like all these on-ramp jobs to the labor force are getting removed. And of course, with AI, that's going up the job talent stack. So it's going up into the white collar jobs too. So we have this, we're basically removing the lower rungs of the job scale ladder, both for our youth and I think for these people that we're bringing into the country. There's a principle that's been in economics for centuries, but Keynes called it technological displacement, where he said that, look, if technology can replace a human body, it should, right? If technology can do the job better, more efficiently, it should do it. You should swap out the labor with the technology. But he said, you got to be careful at the pace at which you do it. If you displace the labor faster than you can find another productive use for that labor, you end up creating a social crisis, the cost of which is greater than the savings of the new technology adoption. And I feel like we're running totally headfirst into that right now and not even talking about it, right? So I just wanted to make sure that folks were keeping that on their horizon too around this topic. Now to your question about the election. Look, I'm not a political analyst, so I might disappoint folks looking for, here's what I think is going to happen in Trump or Biden. But here is how I look at it, though. As you know, I look very much through my economic binoculars. The current administration, I have a high degree of confidence, has been doing absolutely everything it can to try to keep things operating as well as they can up until the election. Right. And that's why I think a lot of the official data, especially the jobs data, super head scratchers for us. Right. We think inflation's higher than it's reported, probably is. We think jobs are worse than officially reported, probably is. Right. The fiscal spending side, I think a lot of that fiscal spending is to try to pump up the economy up until the election. Right. A lot of that stuff, as I said earlier, we're trying to extend the unsustainable. A lot of that stuff, once the election comes, let's assume Biden wins. Right. He's going to say, OK, you know what? I've been using emergency measures to get to win this election. This stuff has a high cost. I got to let some of the froth out of this thing. I need to lower the bar so that when I finish my term, I can cross the bar. Right. So, yeah, maybe my first year, year and a half is going to be rocky as I let a lot of this stuff correct. But then I'll finish strong. Years 3, years 4, I'll be good, right? Now, I think if Trump wins, first off, if Trump wins, the Biden administration is going to absolutely drop whatever they're doing to prop things up, right? And Trump's going to basically say, great, like, let me let it all flush out. I get to blame it on Biden for the next 2 years. And that lowers my bar. So then I can finish strong in years 3 and years 4. So I can kind of make an argument that no matter who wins the election, a lot of the excessive, extraordinary, propping up that really shouldn't be happening right now will probably get pulled to a decent extent. And we will likely see both an economic slowdown / contraction and/or pretty sizable market correction as a result. And I think it serves the interests of the incumbent, at least in that following next year or so. So I'm kind of on, correction watch after the election.
Yeah. You think RFK has a shot?
Like I said, I'm not a political analyst. I'm really glad that he is in the race. Look, we have such a sclerotic political system. The fact that it's basically Biden and Trump, when we had tons of time, to develop a deeper bench on both sides and get new ideas and people that could maybe bring more of the country together than either of those two. And we haven't, really shows kind of how broken our system is. So I love the fact that there's a new entrant and I'm very apolitical, very intentionally. But I think a lot of the questions that RFK is asking are questions that need to be addressed. And so I'm excited for that being added to the dialogue and how disruptive is he going to be in the race? I'll leave that to other political analysts, but I'm glad he's in there.
Yeah. I want to kind of circle back around before, we close up here.
Yeah. By the way, this conversation's gone in a ton of directions I didn't expect it's going to, but it's so fun to talk about this.
I know. I think people, people will definitely find interest in one of the things that we covered here, Adam. So I think it'd be important that I drop chapters so that in this video, they can get to what they would be most interested in, even though the chapters really aggravate me because people are like, put chapters in your videos because I do long form videos. The problem is it's hard for the viewer to, skip around and go back because it complicates things. I don't know if you have.
Well, that, and also too, like, because we have the ability to introduce nuance into the conversation. If they jump to a chapter at the end and we make a statement, they might not have all the context leading up to it. And it may sound like, well, that's kind of a weird extreme point he just made. Yeah.
What I tell people is just hit the pause button or save for later, and then you can pick it back up again when you're back on the elliptical or driving down the road or whatever. Be careful if you're driving. But I want to talk about, because this directly impacts my business, is the commercial real estate market. Because a lot of people think that the pandemic was this phenomenon that took place where, people work remotely and office buildings sit vacant. You said something that is, and most people don't realize this, they being, you could say special interest groups, pushed agendas that were passed and became regulations that made employees extremely expensive for employers. Instead of it directly being to, you're getting paid for what you can help the business profit, it became very top-sided with costs of having employees, insurance costs, it goes on and on. I could list them, and then people would just be upset because I'm saying they don't
workers' comp, OSHA. I mean,
it goes on and on and on.
Yeah.
Department of Labor and Licensing, right? All these different regulatory agencies. And I'm not saying that we don't need them. Believe me, I'm not. But what I'm saying is what you said was the cost of employees are high. That in itself, but I want to take it one step further because you said Wall Street has a lot of influence. Wall Street, and so does the Capitol, or the administration. But Wall Street is concerned about their shareholders. So out of all of the cost of having employees, they have a duty to their shareholders to deliver profits.
Exactly. Yeah.
Right. So what we've really built is a system that is going to force employers to use AI. So we would be ridiculous if we didn't think this would progress, and escalate to the point of job loss on a massive scale. Now, there are people that are writing AI, and a lot of them are, in the Silicon Valley companies. I know some of them personally that are they have these AI companies, and they say, no, you have it all wrong. AI is going to build jobs. It's going to enhance. Blah, blah, blah.
Right.
Let me tell you something. When it gets to a point that a Wall Street company has the duty to their shareholder to eliminate the job, the expensive employee, and replace them with a robot, they are going to do it.
Absolutely. 1,000%.
Over and over and over again. So I think, my friend, that is going to be, and I think collectively, Adam, it brings us full circle, because when we're talking about what's not working now with the U.S. economy, this is going to amplify those problems, because it's going to ultimately get back to affordability from a job loss standpoint, and that's going to be devastating.
So I absolutely agree. And look, I don't think that there's sort of a master plan to make people serfs of the elite. I don't think that there's a cabal of rich people that meet and plan this type of world domination. That said, I think just human interest and corporate interest playing out over time kind of gets you to the same ending. And it's exactly what's going to happen with corporations embracing any technology where they can shed, humans. And their way to deal with that in the interim is to try to just make it as easy as possible for people to get access to credit, so that as they continue to struggle, they can still purchase on credit, right? But you get to this point called debt saturation, right? Where the consumer just can't take on any more debt, because if I take on this new debt, I can't service this debt here, right? Or they get to the point where the creditors cut them off, where they're just like, I'm looking at your credit rating here and you're toxic. I can't touch you, right? And we're in danger of hitting that. And I think that's going to be a part of going into this next recession, is we're just going to start having more and more consumers just kind of, leave the buying pool because they're just maxed out, right? They've just literally played every trick and they could. And consumers are incredibly crafty. I mean, they'll find all sorts of ways, and that's why buy now, pay later just came into the picture. Oh, can't get a credit card, but you still want to buy it? Okay, well, here.
You want to eat? You want to buy this week's groceries?
Yeah, well, and sadly, that's where we are right now, is we're seeing more and more essentials of living being placed on plastic, which is why we're seeing record revolving credit card balances at consumer households. And very sadly and worrisomely, those credit balances are now charging record high APRs, right? So it's the most debt we've ever had at the highest expensive cost.
Yeah, I saw one of my credit cards, and I'm fortunate that I get to pay them off every month. But I use them for points, and at work I try and buy everything. I mean, look, we've got more subscriptions that I don't even know how many subscriptions I have. And my credit card company, I just look at it, it's like, wow, do we actually, are these somebody else putting these on my card? But anyway, I was looking at the at the terms, because I was just curious. And it says if you fall delinquent or something like this, if you miss your payment or you do this or you do that, 34.999 or some crazy interest rate is what they can charge you for an indefinite period of time. They don't ever have to get off of that, right? So you maybe you're at 14.99% as long as you're behaving and being a good actor. But the minute you fall late on a payment, they can take you up to 35%.
Yep. Well, so that's the landmine that's hidden in buy now, pay later, where it looks like it's cheaper than credit card debt, but if you miss a payment, it just goes bananas in terms of what you get charged. To your point, like, I'm sure you've got a good credit card rate. The average credit card rate is like 24%.
Yeah.
and if you can believe that. So I'm sure those
Yeah.
people have an even more grotesque penalty rate that they get to. Let me just mention this because people ask me this all the time. They say, Adam, don't worry about credit cards because most people pay those off at the end of every month. And I went and grabbed the data. It is only 35% of cardholders pay off their monthly balance. So that means 65% carry a balance, and nearly half of those who have credit card debt say it would take them at least a year to pay it off.
They pay the
right?
minimum balance.
Yeah.
I mean,
And
the minimum payment requirement.
Right. And so basically, no, most people don't pay them off. In fact, more and more people are struggling under the weight of this. And of course, as the rates go up and the price of everything goes up, right, it just gets, that's more and more weight that's pulling down on this person. So, so yeah, I mean, we're if we haven't, kind of beaten this horse to a bloody pulp here, end of the day, we have a economy that's powered by consumers. We're doing a lot of things in the short and long term, right? Whether it's higher cost of debt today, whether it's risk of job loss in the medium term, whether it's risk of your permanent job loss through AI, in the long run. We're doing a lot of things to injure the golden goose that powers the overall economy, right? And so getting back to my original point about the whole lag effect here, sadly, I think kind of the beatings are going to continue until morale improves, to go from that old statement. So I think the lag effect, as it arrives and increasingly arrives at intensity, is just going to make things worse and worse and worse for the average consumer. And that's the type of thing that I'm trying to get people to prepare for. I'm not trying to sell doom. I'm not trying to tell people the world is ending tomorrow. I'm just trying to tell you we've had a lot of tailwinds at our backs for a long time. I mean, the period from the great financial crisis until 2021 was like eternal summer, right? I mean, the housing prices did nothing go up. Stock prices did nothing go up. Bond prices did nothing but go up. It was easy for all of us. Yes, there was the blip there in COVID. It wasn't a fun time, but they shoved so much in the system that everybody who lost a job got hired back. Everybody whose 401k got damaged, well, that went off to the races after that. And now we're getting to a point, I think, where that just cannot continue. And as the lag effect really begins to arrive in force, because it's taken so long to arrive, I think we have to prepare for the potential of maybe several years ahead of headwinds versus tailwinds. And that's kind of the main message I'm trying to get out to folks these days, Todd, which is, all right, well, look, if that's the case, then, what should I do? Right. And, congratulations to your viewers, because the first thing that you should be doing is getting yourself educated about truly what's going on and where the risks lie and which risks you want to prioritize as the ones that you want to protect most against, and then start creating an action plan for that. So I don't necessarily tell people you should get out of the stock market entirely right now. I just think if you remain long, well, then you should probably have some hedges in place. If you're sitting on some stocks, let's say you have owned NVIDIA over the past bunch of years, you're on phenomenal gains. Maybe take some of those gains off the table, right? Not a bad time to maybe move some of your portfolio more into safe securities that pay you a nice return. It's rarely been a better time in our living history to own treasuries right now in this type of environment. So there's an awful lot of things that you can do. If you work for a paycheck, you should ask yourself, how at risk is my job, right? And if it's higher than you think it should be, well, then maybe you want to actually start investing in, upskilling a little bit, make yourself a little bit more marketable, a little bit more essential to your current employer or to a competing company in your field. Maybe don't wait until you get laid off to start knocking on other doors. Maybe you want to start having lunches with other people in your industry right now and just be a known commodity so that if your company falls in hard times, you already have a foot in the door, a relationship in the door somewhere else. So there's a lot of things that you can be doing right now. I think the vast majority of people are just sleepwalking through this, right? They don't like to think about this stuff. And to a certain understandable degree, they're just overwhelmed with life and they're just trying to get through their workday or manage their families as they should. But what's coming may impact all of us. And to go into it with no plan is that, to fail to plan is to plan to fail, right? And I'm just trying, like you, to wake as many people up to the realities on the ground so that people can make more informed decisions to hopefully position themselves prudently for safety, but in certain cases, maybe position yourself to profit a bit from some of these trends as well.
Yeah, Adam, I think it's all great advice, and you and I, we're going to stay on close watch of everything that's going on, and we'll continue our conversation. And man, thanks so much for being on the channel, guys. All of Adam's information is in the show notes. Cruise on over to his Thoughtful Money. Great interviews. We also will put the link to the Fed interview with Thomas.
Thomas Hoenig. Yeah, I probably mispronounced his name 5 times during my interview with him until he told me it's.
He corrected
Hoenig.
you.
They think of it like Han Solo. Yeah.
Okay.
Hoenig. Yeah.
Hoenig. All right. Well, we will publish that also below. And Adam, thanks so much for your time.
Todd, it's always a pleasure. Thanks so much for having me on your show. Thanks to your viewers for hanging in with us to this 2-hour mark here, whoever's left. Hopefully we didn't offend too many people with the third rails that we touched here, but folks, really hope that you just enjoy, hopefully kind of, courageous but honest discussion of today's main issues. And a huge thanks to you, Todd, for creating the vehicle and the platform for that to be possible on.
Yes, sir. Likewise.
All right, buddy.
Okay, Adam. All right, guys, did you hold in to the very end? I hope you're hearing me talk about this outro right now. Really, I'd love to know your thoughts and comments if you could drop them below. If you like the video, you can let Adam and I know that you did by hitting that thumbs up. It helps the algorithm, helps to share this video with more people. And also, you could share it yourself. The share button is below. These are certainly topics you're not hearing in headline news, mainstream media. So the biggest compliment you can do for myself and Adam would be to share this video with your family and friends. And finally, guys, if you haven't subscribed to our channel, consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.